again, today we'll be looking on manufacturing accounts. So what is manufacturing account? As you all can see here, we have a factory. A factory is a place where we take in raw materials, combine, mix, do whatever kind of processes, you put them into the machine to be processed, and the output, the product that form, will become a finished product. Okay, let's say a bread. We need something called our raw materials. For producing a bread, our raw materials mainly are here. This is called as our direct materials, okay, direct raw material. So for us to produce bread, what do we need? We need flour, we need yeast, we need all kinds of sugar, salt, and many more things. Okay, for example, we have a flour, we need to have yeast, we need to have water. Okay, water is free. We need to have sugar, any amounts of salt, any other kinds of chemicals, okay, which are edibles, right? So these are some to mention. Yes, of course, we do need eggs to make bread, okay? So direct raw material has its cost. We have the purchasing cost, okay? We purchase the cost, we purchase the bread, the yeast, the sugar, the salt, the eggs, the flour, all everything. There's a purchase cost in it. And of course, we do have opening inventory of raw materials. And of course, we do have closing inventory. Okay, what is the meaning of opening and closing inventory? Meaning, at the beginning of the year is the opening, how much we have. Closing is what we have left at the end of the year, which will be the opening of next year. That's the opening and closing inventory of our raw materials in our raw material warehouse. Okay, so when we buy these raw materials, there may be carriages, meaning some sort of like a delivery fees that is charged to us. Okay, carriages fee for these raw materials. Now, other than raw materials that we need, we also need manpower. So manpower will be termed as our direct wages. Okay, people who are directly in contact with these raw materials to place them into machines to run through many kinds of special processes are the operators. So like as you can see here, okay, here's a bread manufacturing company. The people who actually touch the bread, the flour, they need to mold the flour, right? All everything. They need to put it in somewhere and then put some the right amount of water in it. Okay, put all the right amounts of the eggs, sugar, the salt, and all those other chemicals inside the bread. Okay, the dough. So these are the people who are engaged directly. They touch the things. They touch the raw materials. Are known as our direct wages. Okay, direct salaries for the operator of the factory, the person who operates the machine, who touch the things. These are direct wages. Other than that, of course, we need to protect our product. Okay, we cannot let somebody else use our tagline. You cannot let simply anyone to use the same materials and the same name and in fact the same logo as us. If there is somebody who does that, if we have copyrights, patent or trademarks, we are able to sue them in the court, definitely. So this kind of expenses is known as direct expense. Right? So our royalty, trademark, patent, copyright, something that protects us, is our direct expenses. Now, all these directs, all these three directs, once we add them up, we will get something known as our prime cost, primary cost. Okay, this is our prime cost, the main cost. If we have prime minister, the main leader of the country, then we have also the cost, the cost leaders, which are the material costs, wages costs, and the expenses costs. Those that are directly in contact with the product that we are about to produce. And if we have direct, of course, we will have something, the indirect. Okay, the indirect cost is here. Indirect cost, or known as the factory overhead. Okay, this is the first part over here. And we have the second part right here. These are indirect costs. For example, okay, notice that the person who are in contact with the raw materials normally dress quite, a bit quite casual, with all the safety gears, and you see them, they are protected with their hair, with the cap, all. And we will have people who are dressed quite formal. Normally, these will be our factory managers, factory supervisors, the guard who look after the factory. These are indirect costs. Why? Because they do not touch the raw materials. They do not touch the product. They just being there to oversee the whole process of manufacturing process. Yeah. So other than these, okay, let me give you the examples. Salary of the guard, salaries of the factory manager, factory supervisor. Not to forget, we also have this over here. What's this? Lights. So we need to pay our rates. Then we also have rental, the factory rental fees. And what's these things? These are all our machines, right? All our machines. So what can you think of when we are talking about machines? What are the expenses of some sort? Well, yes, we will have our depreciation for factory machines. And of course, other general expenses such as maintenance costs. Okay, we also have some sort of a depreciation for our loose tools, like here, factory hand tools, where they will be revalued each year, and hence we are able to somehow find their depreciation through the revaluation process. Meaning, in the beginning of the year, okay, the opening, okay, like the brought down figures plus any purchases of the hand tools, and minus the value of the hand tools at the year end, then you'll be able to find the some sort of a depreciation. Or sometimes they call it the hand tools that you purchased for the year. Yeah. So other than hand tools, we could have also factory stationaries if you are using stationaries by these managers. They all. Okay. So these are our indirect costs. Now, when these prime costs adds up with the indirect costs, you will get something in total called the production cost. Production cost. Okay, meaning the total cost for our production of, let's say, here we can see bread of a particular company. Okay, so this is our production cost at the end of the day. So just to share with you all, manufacturing is part of the management paper that you and I, once we reach into our tertiary education, we'll be learning a separate course in our professional accounting program. If you're doing the accountancy, there's one paper called the management. Beginning, we call it the management accounting. And after that, as we advance to the higher level, they will name it as performance management or cost management and advanced performance management. When we come to management paper, we are most of the time dealing with factory issues. Like for example, because let's say if you are a bread company, you can choose to buy your own bread from a supplier, or you can produce yourself. So whether to produce or to buy really depends. So there are management techniques to calculate in university's time. Okay, so there's some extra things that everybody can know about. Okay, I share with you all so that next time when you look at it, it's like, hey, I remember this. Yeah. Okay, so once the goods are produced completely, these are called our finished goods over here. You see all this bread? They are put into the compartments. Okay, these are all the finished goods. So there will be somebody dealing with all these finished goods. Later on, these finished goods will be, okay, so let's look over this diagram. So bread production company produce this bread. So, well, they will have a lorry. They'll send all this bread to the relevant shops. The shops, the bakery, the bread shop, or restaurants. Yeah, yeah. So we have a factory. Once factory is done, they'll send them to that particular company of who owns the factory and who is a wholesaler to all the relevant shops, cafes, bakery. Yeah. So I'm sure the company who owns factory for bread, you all can think of your particular country's bread company that you all love to eat. Yeah. So like in Malaysia here, we have the Gardenia. We have also the Massimo. Yeah, these two brands quite famous here in Malaysia. So this is what I can think of. And they will send all these finished goods to all the shops, all those speed marts. Yeah. So they're a wholesaler. They will send this to all the shops, and they will eventually sell it to us, the consumers. Okay. So now, how's the accounting treatment here? Okay. Well, in the exam, you'll be testing most of the time on the manufacturing account and part of income statement. But here, we give you a full-fledged ones just for knowledge purposes, because for 20 marks in the exam, this is too much to be tested on. Now, let's see here. Manufacturing account, let's say we take from one sample somewhere. Okay. We do have here the manufacturing account for the year ended 31st August. Okay, normally they'll test you with two accounts. One is the manufacturing account and one is the income statement. So first part is manufacturing account for the year ended this date. So we have here the direct material cost. We have the opening plus purchase minus closings. Hey, it sounds like our cost of sales, right? Okay. So if there's any carriages, we add on. Then that will be the cost of materials. Then we add the direct wages, the direct labor to be exact. So let me change here. These direct wages, sometimes we use the word direct labor costs. Direct labor, that's the best one. Direct labor, then they call it manufacturing wages and so. Now you guys might be seeing here why we add some things, right? Definitely it's about adjustments. Adjustments continue to be with you up until manufacturing accounts. then we get the prime cost. Okay? And of course, inside here, if there's any direct expenses, then so be it. Then you had your prime cost. Then you plus your factory overheads, all the supporting costs, the electricity, expenses, rent, depreciation, factory manager, wages, and those. Now we will add our opening inventory for work in progress and minus off the closing inventory or work in progress. So what is work in progress? A work in progress is materials that are going through a halfway series, meaning it is started as a fluff, 0%. And once it's become a dough, it is let's say, 20%, let's call it a 20% work in progress. So opening work in progress is yesterday's. Okay, let's think it as a January to December kind of a accounting period. Yeah. So opening is January 1, 2025. It was the closing of yesterday, 31st December 2024. The 20% done kind of work in progress, the dough. Now at the end of the year, 31st December 2025, how much is it left that is not yet done yet? Yeah. So it will be a 0%, okay, to a X%, and then it will end up become 100%. 0% there will be definitely a raw material. X% is a work in progress always. 100% will mean finished goods. So finished goods is our production cost of goods completed. Work in progress closing, what is left undone yet? Then we minus off. So opening, we have something not yet done, and then as we go through the year, a lot of things are done, then add minus off what is not yet done. So the only production cost of goods completed is the one that is done 100%. Okay, so that's what it means. Then we will normally be tested also for income statement, but however, in your syllabus, what I can see is most of the time they will stop at gross profit, because if they want to test something on the administrative expenses, the other income and other expenses, then that will be a bit, quite a lot of marks. So why they touch on income statement? Well, as you see here, in factory part of this company, let's take the famous one in Malaysia, the G company, okay, G brand company, the Gardenia, okay. For its factory, it will have its own manufacturing account. Once it sends to its own company just right beside or another few kilometers away from the factory, the company itself also will have their own income statement. So it's separate. However, the income statement will mean what? Okay, still remember just now I tell you all that we can buy or we can do it ourselves. Here you are. This will become our cost of sales. We have our opening inventory of finished goods. All the while that you have been learning from your sole proprietor days in that chapter, okay, it's all about finished goods. The one that is in your shop that you buy from supplier. Those are finished goods. Then you add on with production costs. If let's say you produce, then sometimes a company, other than producing their own finished goods, they also buy from their supplier purchases of finished goods. Because sometimes if there's a demand and you are lack of labor, lack of materials, you are out of things, you need to buy out some from a supplier elsewhere. Okay, then you minus of closing inventory of finished goods is pretty much the same here over the raw materials. Don't do it. Yeah. So then you get your gross profit. Then if they want to go further ahead, well, plus other income minus expenses minus your financial charges. You need to remember there's a loan interest that we minus off. Then we will get the loss or the profit for the year. Yeah. So one thing is that there might be apportionment. Meaning, let's say, okay, let's see here, we have depreciation, yeah? Okay, of course, depreciation here, there will be, as usual, income expenses, there will be, what's this called? Adjustments. Okay, let's see, is there rent? Okay, rent, Now, rent could be a very huge figure, but then they will apportion into, let's say, 20% is over here, 1,003, and then the balance, 2,005, okay, the amount is 80% to apportion to split between the factory and also the office. Income statement will be meaning the office, the company. So they might be apportionized. Okay? So they apportionize so that the profit will not be too low. Yeah, so they split it. Okay? So that is apportionment. And lastly, we have our financial statement. All everything is the same. It's just that our current asset is different. Inventory left how much at the end of the year. So this is actually closings. All these are closing. Closing inventory of raw materials, closing work in progress, and the closing finished goods. Okay, let's say the closing finished goods. Yeah, over here. And the law applies again. Whichever is smaller between the cost and the NRV, the net realizable value, the selling price that the market will accept. Okay, so this is about it for manufacturing accounts chapter. And I shall see you again soon. Okay, thanks for watching. Remember to like, share, comment. All right, also subscribe to my channel, and as well as click on the bell button for your notification for any updates and new videos coming from me. Okay, see you soon. Bye-bye.